In this video, guys, we're going to look at fading the crowd with this setup. Stay tuned. Hey traders, warm welcome to you. So a bit of a price action setup for you. This is fading the crowd, the retail guys who are piling into this trade, thinking it's the right thing, and we're looking for signals that it's not the right thing, and we can take the opposing side of the trade. Let's look at it more closely. So, for example, now we have market, let's call it euro for now, whatever. We're in a downtrend, okay? We're pushed down, and we don't want to be in like a brutal downtrend. We want to be in some scenario where we're pulling back. Ideally, as you know, if you're a subscriber, but I appreciate your support, guys, we want to be within a broader uptrend, and this is a small downtrend within a broader uptrend, ideally. But, you know, let's not get into too details. Let's just go through some of the details of the actual price action trigger, and where you put it is going to be up to you in terms of your own trading plan and what you know to be profitable and a successful way of playing buys on longs on levels, key levels of support. So this is basically, that's our pattern. We've come down, we've tested a low, is a low, and if we put this as 0.1, we've pushed back up, we've come down, we've broken through that low, and we're at 0.2. We've pushed back up again, we've come down, we've retested, and we're at 0.3. Right, so let's explain what's going on here. So we're coming down, the market's coming down. Imagine that we've pushed down from wherever it may be, and now we've come down and we've made a low. So everyone's seen that low print. Everyone's going, okay, there's the low print, fine, and we'll mark it on the chart. Then we get a rally and pushes back up, and that might suck in a few buyers, or people might be selling it for a push to lows. Then this is the important thing. We come down and we drive through 0.1 and we break cleanly through it. Whatever time frame chart we're looking at here, it could be intraday, it could be daily, it doesn't matter. It's the same price pattern. We come down, the important thing is now we break through 0.1. Now, this will suck in a lot of people on the short side. People who are short here will be thinking, great. People who are long and pushed into that will be coming out of the position here. Because we've broken through, it's the textbook thing to do. Then we have a rally off that low, and that's another important thing, because this upsets some people who have driven that short. This also gives encouragement to people who are long, and this subsequently people think, okay, well, it's a break. Now we get a third move and a third test of the low. This is candle 3, and by the way, it doesn't have to be specifically this shape. I'm just doing it purely for example purposes, but we start to push lower, and in this instance, we don't tag level 2. We tag where level 1, the low of level 1. So yes, this is almost like a triple bottom, but we're drilling right into this in a price action perspective. And at that point there, we're then looking for the next green candle, this bad boy here, and that is our long entry with our stop under the low here. Now, why is that? Because if you think about what's happened here, people have come in, they've gone short, or the sellers are in control. We've bounced up, buyers are a little bit more excited. We break through. This break, this is the sweet spot here, the break and the subsequent bounce up, because it's just adding loads of confusion. It's showing, okay, sellers are sucked in on this low, but in actual fact, buyers stepped up and realized that that was value. We saw a rally back up. They couldn't have enough force to push it higher. So again, sellers got sucked in. So we're wrapping more and more sellers into this who believe this is now going to break. And of course, it could still break, which is why we must have our stop loss in place. But this price action, especially when we've broken through the low of 0.1 and held, then retested and held actually higher. So it's a higher low. And yes, we've got all the rules generally that we can put into this, but the fact that it all sits in this same structure, all fits together like this, means that it's so much more powerful. Then we can trigger a buy as we come off that low. And the important thing is, guys, with this is we can quantify our risk. You know, if we look at some of the better trades out there, if you look at some of the all better trades there, when you can quantify the risk and it's a sensible place to put the stop. In other words, that's a sensible place to put the stop. And it's a good risk reward ratio, whatever that may be. If that's your risk, you've got plenty of room for a 5 times your risk reward play just by coming back to that high. In actual fact, you would be looking for a broader play for a push back up, and hopefully if you're playing this within a short-term downtrend with a longer-term uptrend, then you're looking for a resumption of the trend up to high. So you can look for this kind of pattern on pullbacks, longer term pullbacks over several weeks or whatever it may be, if you're on a swing trading perspective, with a push to high. So you're quantifying the trade with the risk there. You're waiting for that probe through the low. You're waiting for the subsequent test that doesn't go near that low, but it does the first low. And then an easy way of doing it is to wait for the next green candle. Now, of course, you can finesse this a bit if you want. You can kind of look and say, as soon as it comes back up under the low, go long there. If you want to be a little bit more aggressive with it, you can wait until it breaks the high here. If you want a bit more passive with it, of course, you're going to adjust your position size to suit and the risk order ratio will change. That's a good idea to kind of wait for that first green to ensure that you're not just going to push through and it's going to do another red candle, another red candle. Now, of course, the next candle after that could well be red and could break through, which is why you got your stop there. But you've seen enough evidence along the way to suggest that this is not a bad trade. It's worth a go. It's a decent risk reward ratio. It's got a reasonable probability of success, and there's a nice quantification of my risk right on there. Anyway, guys, that's fading the crowd with this setup. Hope you enjoyed it. If you did, a thumbs up is much appreciated, as is a subscription. Take care. Comments in the comment section below as well. All right, guys. Bye-bye.